The size of the central bank balance sheet matters to the extent that it determines the amount of liquidity in the hands of the private sector. And the private sector, including the commercial banks, can be economical with liquidity. They can get by with very little, or they can get by with a lot because they're holding a lot in reserve in case there's a sudden demand for it. So really the need for central banks to wind it back, to reduce the amount they have, possibly arises because they think that commercial banks will now become more willing to lend as a consequence of increasing confidence, changes in regulation and so forth. And if central commercial banks start to behave in that way, then central banks should indeed reduce the liquidity in the system. But they should probably do it fairly gradually in line with the offsetting changes on the part of the commercial banks. So it should probably be a slow process. How it can be done, of course, depends how exactly you do it, depends on which country you're in. But basically it would involve either not rolling over existing assets or perhaps selling some back into the market, which is actually a fairly standard central banking procedure. I don't think it matters very much. Inflation is plainly a prolonged change in the general level of prices. You should choose a general level of prices, except in a few very small open economies. You should choose a general level of prices that's of interest to the people who are using the money. So a broad-based index of interest to consumers.